Well, we're viewing the S&P as fairly valued right around the 4,000 level. So we're kind of playing in more of a trading range right now, where we were a week or two back. As we approach 4,200, probably the higher end of that range. We went into this year thinking that 3,700 was an appropriate downside target, at which point we'd want to get more aggressive in terms of buying stocks. We haven't really backed off of that. I think what I would point out is that it's kind of interesting with today's action. You're closing the 10-year right about where we started the year. This year really has been, in our view, a matter of following rates up and down with the influence on that mega cap growth cohort of the S&P.
So we're prisoner to rates. I mean, that's just the way it is going to be for the foreseeable future. If rates tick up, stocks are going to tick down. Mike was talking, too, about what the 10-year had done and the way that stocks reacted as we head towards the last few minutes here.
Right. Well, I mean, that's the way we see it for now. But again, it's important in terms of teasing out where this is being felt. And we've been making this analogy that the S&P can't go materially higher without the NASDAQ essentially leading it. And that's where that rate sensitivity comes in. It's more specific to that large cap growth part of the market that last year proved to be so sensitive to rates on the multiple compression side. That's where your release valve is up and down as we follow the shorter term rate direction.
Yeah, so Mike, okay, 4,000 is where the level that Scott sees. You heard Eric Johnston, Cantor, low 3,000s is where he thinks we might trade. How do you react to that?
I mean, it's both plausible. I would absolutely say that. To me, the October low has looked pretty good. It's had a lot of the kind of characteristics of something where it should actually be relatively durable. And I keep pointing out that was sort of a stagflation narrative that was driving us there, right? So if you're talking right now about, economy's better than expected, maybe the Fed has to go an extra quarter point or so, that's not fatal to where we are right now. It doesn't necessarily mean you retrace all the way lower. Would the market be more attractively valued down there? Would it mean better forward returns from that level? Absolutely. I mean, that's the trade-off. You want the pain now and set up a much better rebound, or do you want to sort of hold these levels and then maybe have it be more of a grind from here?
Scott, when you hear people like Eric Johnston make a call like that, can you get your arms around how we could go down to the low 3,000s in his thinking?
We feel pretty good with where we are with our S&P earnings outlook for this year around this 216 level. I think to talk about an S&P level that's closer to that 3,000 level, I mean, you need to have a much more dire circumstance unfolding in terms of recessionary influence on the earnings outlook. We don't see that in the cards, if certainly for the first half and most likely into the second half. So again, my emphasis would be that earning stability here probably limits some of your downside, which makes us more susceptible to the interest rate movements as a key driver of this.
I appreciate you being here, Scott.